Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We've had some major key developments over the past week. We have a lot to cover in this episode. These are without a doubt very interesting markets. Now, we believe that we are slowly approaching the end of this 12-year bull run that we've had ever since that 2009 bottom after the great financial crisis. We're getting into that last phase of the bull run where we start to get some more speculative price action, like the big breakout we had right here in 2021 of this major bull market price channel, seeing indicators like the equity to money market asset ratio at above 4. So this is the ratio of equities being held relative to cash-like assets. And so we're definitely in the upper end of this range with a lot of risk being taken on equities by a lot of people. Same goes for the retail money market ratio. You've got an unprecedented amount of risk being taken, right? This ratio here, the retail money market ratio, tells you when it's elevated, investors are looking for safety. When it's low, investors are looking for risk. And you can see right here, we're at an all-time low in terms of investors seeking risk in equities. And of course, even from a trading standpoint, if we take a look at the option speculation index, we're no longer in a classic bull market that we saw between around 2001 till 2019. We're seeing a lot more speculative type of price action similar to the levels that we saw during the dot-com bubble. So that's exactly what we cover on this channel. We believe that we're in the final phase of this massive bull run, and that's typically the moments where you see the largest gains in the shortest amount of time, and we are definitely looking to participate in that trade. Now, in this video, we're going to cover what happened here over the past week. What does this correction say about the next few weeks of trading on the S&P 500? What's the next move? Is this it? Have we topped? And hopefully by the end of this video, you'll have the answers to those questions and you'll be on the right side of that trade. Now, make sure to smash that subscribe button if you're interested in following the markets with us. And of course, if you're interested to learn how to navigate these crazy markets. And now, without further ado, let's get right into it. All right, so the first thing that I wanted to show you guys here is the AAII bull sentiment. This is something we often take a look at on this channel, and it's absolutely crazy what's happening here. We have the number of bulls at under 25%. So there's only around 1 in 5 investors actually expecting upside over the next 6 months. Now, if you know anything about contrarian investing, you'll know that you typically want to be selling when optimism is elevated and you want to be buying when there's a lot of fear in the markets. And it's a very, very weird thing to see what's happening right now with the AAII bulls at under 25%, despite the markets being very near all-time highs. And I'm going to be very, very clear here. This is an unbelievably bullish setup we have here. I wanted to check what the last time was where we had this type of setup with the markets at a couple percentage points near all-time highs and the AAII under 25%. And I was only able to find one spot here over the past 3 years, and that setup was on August 30th, 2017. All the other bearish readings were near big bottoms, right? That was a 5% correction. That was a 5% correction as well. That was a big 15 to 20% correction where you had that bearish reading. Obviously, that was COVID, so that was not the same setup as we have now. But let's see what happened here after the 30th of August in 2017. And so that setup was right here, obviously printing a major bottom here, but so a very, very similar setup to what we're seeing right now. You have the markets very, very close to all-time highs here with a grinding price channel type of thing. You've got the S&P 500 bouncing along the 50-day moving average here. Very, very similar to what we're seeing right now in 2021. And then right here in August, you have this 2% correction, and you've got the bullish sentiment that drops down to 25% here at extreme fear. And what follows that reading is obviously a major rally here, an 18% bull run here leading up to the end of the year. This is what FOMO does. Investors that are not positioned into equities and that eventually capitulate into the stock market, that's what creates these types of blow off tops. And just to show you exactly what this looks like, let's put a replay on that. Leading up to that top, this is a massive rally, right? It really does look like the market is going parabolic here. And that was triggered by that fear reading that you had on the 30th of August. So if we copy and paste that move into what we're seeing right now, we could theoretically see this type of move up in the markets here with a significant bull run into the end of 2021 that could take us above 5,000 points very, very rapidly, almost as quickly as you can hit that like button. It only takes a couple of seconds and it helps our channel out so much. It helps us grow and capture new audiences, reach out new people. It's really appreciated. Thank you very much. Now, obviously, nothing repeats exactly like history, but this is just to give you an idea of what type of moves a fearful market can trigger. If we see a reacceleration of growth heading into year end, which is something you very typically see in the year-end months, that could fuel this type of move, especially now that we've had the small slowdown throughout the summer. Tapering is very likely delayed until much later, unless we start to see these types of moves in equities, if we see commodities rising again, economic growth accelerating again, and that would cause a faster than anticipated taper at around the end of the year or beginning of next year. And I also want you to pay attention to that drop here, right? Blow off tops can be very, very damaging if you're entering at the wrong time. The market's going to retrace the majority of that move up in just a matter of a couple of days or within a week. So that's definitely something to watch out for, especially considering the fact that the valuations at these highs here will just be incredible. The PE ratios will be unprecedented. Stock market to GDP will be off the charts. And that will be the moment where everyone's calling for the new paradigm. This time is different. Now, I think it's important for investors to understand these concepts of the fact that the markets are really starting to get overextended here, right? We have this 250 week moving average that I've put on this chart, this blue line. And in the bottom here, I've got the percentage difference in price between the actual moving average and the stock market, right? And so you can see where we're at here. We're incredibly overextended relative to that moving average. If we compare where we are on that indicator, we're at levels of overextension we haven't seen since 1998 to 1999 here, 1987, right before the big flash crash. So obviously these don't predict crashes, but they tell you that long-term future expected returns are going to be low. This is an incredibly strong market. It could continue to be strong over the next few months, but long-term, everything eventually reverts back to the mean. And so we've often said that we're really approaching the end of what we believe to be a 40-year cycle since 1982, where we saw bond yields peak till now, where equities have performed extremely well, bonds have performed extremely well, and we're coming to the end of that. Those same portfolios are going to be underperformers because we're getting into an environment where there's only going to be a handful of sectors, a handful of assets that are going to perform well. And it's not going to be your typical stock to bond portfolio. And you're going to see a massive wealth transfer between the people who understood that and the people who weren't able to anticipate it. Now, what we try to do at Game of Trades is not just tell you guys what we think is going to outperform, like the energy sector that's probably going to make 4 to 5 times higher returns than the SP 500 over the next 5 to 10 years, but actually tell you guys why we believe those things, what goes into our thought process, what goes into our research, our data, all of that work that needs to be done for you to become a better investor. We're really committed to trying to give you guys not only the service where we provide our forecasts, but also education and try to teach you guys why we believe the things that we believe And why we have those convictions, because I do believe that's the most powerful tool that any investor can have, is the knowledge that goes behind the convictions and the decisions that you make. So again, if you're interested in being part of that community with us, learning how it's done, make sure to test out our free trial. I'm going to be posting a long-term investment overview of the energy sector, and you can go and check out the recent articles we made on the complete analysis on whether we're in a speculative bubble or not, and at what stage of the bubble we are, and also what we think is going to happen to inflation heading into year end and how that's going to impact the markets. So again, make sure to click on the link in the description below if you want to test out our service and become part of the growing Game of Trades community on our website. Now I want to take a look at something else with you guys, a little bit more macro and a little bit less speculative than all of this. Now this is a chart straight from the Federal Reserve, and it shows you the percentage of domestic banks that are tightening or loosening. So it's the tightening standards in the banking system telling you how easy or tight monetary policy is. And to your surprise, it's not just about the Fed, it's also about the banks and whether they think that lending out money is a risky investment. Right? Leading up to 2008 here, you can see what was happening to the lending standards. They were tightening, meaning they weren't giving out loans as easily towards the end of 2007. And you can see as we have that tightening happen, that creates a recession. The same thing happened in 1999, leading up to the 2001 recession. You had banks tighten their standards, leading up to that big top and creating that recession. Now you can see where we are right now. We're not at all in tight economic conditions. We're in extremely unprecedented easy monetary conditions still at the end of 2021. This low here compares to what we had in 2011, in 2005, in 1993. None of those points corresponded to big tops in the markets, but I do want to take a look at this chart from a different angle. And instead of looking at this in terms of percentage, I want to take a look at this as the change from a year ago. And so this actually gives you the dynamic behind these changes in lending policy. So these big bottoms we have here tells you that all of a sudden, compared to a year ago, monetary policy suddenly became very, very easy. And so big bottoms, that's 2021, that's 2009 at the end of 2009, that's in 2024, and that's in 1999. So in 2009 and 2004, that was obviously following big market declines in terms of the stock market, right? We're talking about the stock market here. 2009 around this period, 2004 around this period. But then you have 1999 here, and all of a sudden that looks a lot more like what we're seeing right now with speculative type of price action towards the end of a bull run, IPOs going absolutely wild, options going absolutely wild, right? Excessive risk taking in the retail money market ratio, excessive risk taking in the equity to money market asset ratio. And so that easy monetary policy led to that final leg up in 1999, leading up to the 2000 big market top. So again, I'm not saying that's exactly what's going to happen. This is telling me that, we should be bullish in the markets short term, but this is telling me that we should be bullish short term, and then we'll see what happens with the markets. And if we have to change our bullish thesis, we will. And I think that's a very, very likely scenario towards the end of the year that we'll be switching from incredibly bullish to bearish. All right, now that's about all I wanted to talk about in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button as hard as you can. Now, in the meantime, I wish you good luck on your trading and see you next time.